Not all moving averages are created equal, okay? And there's quite a few choices that you as a trader need to make. So we're going to talk about a moving average that uses all available price data, and it is similar to the EMA in some ways. Before we get started, hit subscribe. You can like this video down below, and I want you to make sure you take note of the disclaimer in the description. So we're going to talk about the smooth moving average, and you can kind of think of it as the EMA on steroids. So the calculation of it, we use a combination of the SMA and an EMA. The recent price movement is given the same weight generally as all historic data that's available. And while other moving averages will eventually lose their past data, the smooth moving average doesn't. That past data, yeah, it's given less weight in the calculation, but it's never forgotten. So for a trader who likes less noise in their indicators, this average does a really good job in doing it. So right here, let's compare some. This is a 20-period simple moving average and a 20 setting on the smoothed average. Now you notice the smooth average is not as affected by short-term fluctuations in price like we see in the middle there with the trading range. You can also note that traders that use price that crosses an average as their trend direction, the SMA gives a few crosses that actually failed. Now the short-term volatility, it doesn't really affect the smooth average the same way. And when price crossed the smooth average, we actually had higher prices and lower prices. Here's the formula for the SMMA, and it's a little more complex than the SMA. You can just kind of look through here. Now, what's really important to know what N is. N is just the period that we're going to use for the smoothing factor. The default for that is generally 9, but you can put that to whatever you feel like. So how do we use it? Really, the smooth average, you're not going to use it much differently than a standard average like the EMA. You're not going to use it any differently than the DEMA. What we're really talking about is just preference. But with that smoothing feature, some longer term traders may find some use in it. When we consider for trend determination, and it does strip out erratic price moves because of the weighting factor, it will react slower to real changes in price. Now, depending on the time period that you choose for it, the SMMA could be giving signals long after price actually did. So on this chart here, I'm just using a 50 SMA and a 50 SMMA, and during the uptrend, we see no violations of the smooth average. Now, both of these averages, I think they did a good job of showing a steady uptrend, with the exception of a few breaks of the 50 SMA. The real issue is on the right side of the chart. Price clearly shows momentum in the upward trend, and you can see that by the large impulse swings. You see price puts in a lower low at that black line, which signals at the least a potential trading range. Now, the 50 SMA, it's broken with authority, right? It's a strong break, but due to the smoothing of the SMMA indicator, the signal for a trend change is delayed. Now we can speed up the indicator a little bit by setting a smaller period. And what is the best setting? There isn't one. And spending your time looking for a perfect setting really is a waste of time. You should just focus more on strategy design and your risk protocols. But for comparison, look at this chart. We see a few things. We see the 9 SMMA and the 20 EMA. They track pretty close to each other. The 20 SMA catches up to price, and the other two averages near the top as price consolidates. The 20 SMMA, the smooth one, stays far away from price during the trending move, but there is a point on this chart that all the averages will converge. So do these differences, even the more subtle ones, make a huge difference in your success? Well, if you watch other videos on the internet, it can spell the difference between a winning and a losing strategy. And I'll say this, don't believe everything you watch or everything you read, because it takes a lot more to succeed in trading than just finding an indicator setting. Now, what's interesting is due to the formula of the SMMA, the larger the period setting, the further it will deviate from another average with the same setting. So on the left, we have a 10 EMA and the 10 smoothing average. On the right, I changed the settings to 50 for both of them. I want you to notice how the distance between the two averages is larger when you're using a larger period setting, right? So that's something you need to be aware of when you're choosing not only your setting, but also the moving average you're going to use. Because remember, the smooth average is going to take into consideration all available price data on your chart. And let's have a trading truth talk here for a second. When we talk about indicators that are tracking on average pretty close to each other, if you have a robust strategy, it should have very minimal impact on your results. So if your strategy does well with an EMA, but it fails with an SMMA, double check your testing methods, right? It's no different when considering small changes in periods. A 20 period EMA or a 21 EMA This should have no difference in your strategy between those two. I'm not going to go into a big strategy about this because any moving average strategy you find on our channel could be effective using this one. The calculation, yeah, it's slightly more complex than a simple moving average, but just because it's complex, it doesn't mean it's going to be successful. The smooth average, it does have some benefit of the EMA with the recent price weighted a little bit more, and it also uses available data, although it's further back in time and it's less relevant to the present calculation, but it's a part of it. Is it better than an EMA? They're both in the same general vicinity on a price chart when you use the same period, unless we're going into a higher period like we saw with the 50 period. The real question is, how good are you at reading price action? You know, the SMMA is just showing you a smooth price averaged over time. Personally, I have no reason to use anything but an EMA or an SMA for my own trading approach, because you're going to find a multitude of moving averages in your charting platform. So really, instead of just obsessing over the best one, just pick one. Right? Pick one that suits you, that fits your eye, one that looks good on your chart for how you're trading. It doesn't have to get more complicated than that. Again, if you have any questions or comments, put them below and I'll do my best to answer them. Hope you subscribe to the channel here, like this video, and we'll talk to you soon.